Welcome back to Beyond the Ledger, where we look past the numbers to uncover the strategies, risks, and opportunities shaping today's businesses. I'm your host, Shardae Layfield, and today we're diving into a topic that sits at the intersection of strategy, compliance, and global business operations: transfer pricing. In this first part of our conversation, we're starting with the foundation: what transfer pricing really is and why it matters. Joining us are Abbas, Raza, and Ergle from Bennett Thrasher's transfer pricing practice, two advisors here to explain how companies can stay compliant, avoid costly pitfalls, and navigate cross-border transactions with clarity and confidence. So let's get to know you guys a little bit better. So Abbas Raza is a manager in Bennett Thrasher's tax practice, where he supports clients across a range of tax, accounting, and finance matters. He specializes in transfer pricing, providing benchmarking, cost allocations, intangible valuation, and economic modeling to help companies align with global regulations. And Ergle is a senior consultant in Bennett Thrasher's tax practice as well, supporting clients across tax, accounting, and finance projects. He focuses on transfer pricing, including benchmarking, cost allocations, intangible valuation, and economic modeling. So, thank you all for being here today.
Thanks so much for having us.
Dig in and learn a whole lot more.
Yeah.
All right. So, first thing, to kick things off, can you break down the basics for us? So, what is transfer pricing, and how would you describe an intercompany transaction in simple terms? We can go a little bit deeper after, but just the basics.
Well, there's a long-winded answer and a even long-winded answer.
Okay.
What transfer pricing
Let's
is.
go for it.
But first off, it's important to understand what a related party transaction is.
Mm-hmm.
And that is when a company owns another company or has control over them.
Okay.
And they interact with one another. In other words, they transfer some kind of value.
Mm-hmm.
And that value transfer, it can be a number of different things. It could be a service transaction. It could be intangible property. It can be financing.
Mm-hmm.
That transfer needs to have a price, and that is the transfer price. And another way to look at it is, besides related party transaction, it's a controlled transaction.
Okay.
Because it's controlled by the entity itself and market forces don't dictate the price,
Mm-hmm.
It presents an opportunity for tax planners to try and assist and help with reduce their tax liability, while also maximizing their revenue and whatever tax jurisdiction they want.
Mm-hmm.
And then from the other perspective, from a tax authority perspective, because that entity wants to reduce their tax liability, a tax authority wants to know, hey, you guys are doing this right?
Right.
We want to know. IRS wants to know they're keeping the money where they want it, which is with them.
Right.
So that is essentially what transfer pricing is. Yeah.
Just in a more maybe relatable way for someone that has never heard of transfer pricing, it really is just what would I pay for this service that I'm getting from myself?
Okay.
You're one company with two different entities, and you're trading with yourself essentially, and so it's very easy to say, I just want that thing for free.
Right.
But if you do it for free, well, that means the tax authority is not getting that sales revenue being recognized. And so another way that I'd say is, I want $1 million for it when it's a piece of paper. Why not?
Yeah.
Right. For one other reason. And so obviously that has its own other consequences. So for us, transfer pricing is finding that middle ground, or what we would call the arm's length standard, which is basically, what would unrelated parties pay or third parties pay for the exact same thing? And that's what we're ultimately trying to do in a transfer pricing engagement.
Thank you. Okay, so that adds another layer. Okay. So once we understand the basics, the next big piece is services. So how would you explain intercompany services transactions and what actually counts as a transfer pricing service transaction?
So like I said earlier, there's a few different types of value transfers in transfer pricing. So there's tangible goods, intellectual property, financing, but probably the most common is a services transaction.
Okay.
And a lot of them, the most common would be, support services or management services, but there's all different types. But the main thing and the key is to understand if there is an actual intercompany transaction to identify. We do something called a benefits test. So that is basically what we're saying is this entity have some kind of incremental benefit from a service being provided by a parent company or whatever.
Right.
And if that's the case, then they need some kind of compensation or remuneration.
Okay.
That's important, or that's an important distinction to have, because there's instances where somebody might be doing services, a parent company might be doing services, and it's not necessarily for the benefit of an entity, it's more for the group, or it's more for the investors or the shareholders. And that would be something called like a stewardship activity. So that instance would be like a CEO, and they just invested in a subsidiary, and they own a U.S. company now owns a U.K. company, and they want to expand their market into the U.K. or in Europe. So if they start doing, that CEO starts doing like market research or trying to expand their customer base up in the UK, that's not necessarily sales function for the UK. That's more for the benefit of that investment in that UK market.
Okay.
So that wouldn't be something that would necessarily be remunerated. That would just be something the parent would have and on their balance sheet or income statement or whatever. So yeah, benefits test, that's how we identify whether or not there's an intercompany services transaction.
Thank you, because I was going to ask you benefits test.
Yeah.
I think Kyle summed it up really well.
Okay.
I would say that, to think about a service, just think about the different departments in a business. You have your accounting department, your legal department, your HR department, your IT department. All of those things are kinds of services that might be provided by one entity to another. I think a lot of people may have a customer support. A lot of businesses will have a customer support type of department that might be offshore, and they control that entity and they do all the customer support. And so that's something where you would say, okay, that entity that's offshore is providing customer support services to me, or the onshore entity. How much do we pay for those services?
Okay, that puts it in more perspectives. So that brings up a natural follow-up question. How does a business know whether a service truly provides a benefit under the regulations?
One thing to think about this is, would that business have to expend resources internally to do the activity?
Okay.
Or hire a third-party service provider to do the activity? So it becomes like, in that customer support example, the onshore business would either need to hire people onshore to do it, which costs money, or they would need to get a third-party provider that can outsource that service function, or they can say, we want to keep it in-house, but we want less labor. Business reasons, they want less labor costs, less regulation. Who knows what it is, but lots of reasons for it. But they may have a related party that they control. It's just offshore in another country. And so that's where it's you can kind of determine, well, the entity had to get this function done, this activity done, this project done. And so obviously if it had to expend resources in one way or the other, it's receiving benefit, or it was looking for benefit to fill that kind of void in its business. And so that's one way to kind of think of the benefit test, is if you would pay someone else to do it, or if you're going to incur resources yourself. And I think that kind of comes to what Kyle was talking about earlier with those stewardship expenses. If you're working in a country and then your higher ups in the U.S., New York, Wall Street just say, hey, we need the board documents to us by tomorrow. Well, you kind of are doing some type of maybe finance, accounting type work, but it's not really benefit to the UK office. It's benefit to the investors in Wall Street who need that information. So you're maybe thinking more along the lines of a stewardship activity there. Or another way to think about it is the UK company is already doing accounting and finance activities. It has its reporting obligation. And then the U.S. company is also doing accounting to maybe double check the work. And then the U.S. company is like, well, we also did accounting work for you. But it's actually a duplicative service where the UK company is not going to pay someone twice when they're already doing the work. And so that's how you can kind of think of, what is the benefits test? Are you going to pay someone else to do it, or are you going to do it yourself.
Right.
And if you're doing it yourself, you're not going to pay twice to get your
No.
other brother or sister
That
to
would
do
be
it
smart.
too. Yeah,
Smart at all.
so that's I think a way to think about the benefits test.
Okay.
From a regulatory perspective, there's always a few ins and outs, like the stewardship expense carve-outs, the duplicative service carve-outs, but that's what the way we kind of think about it in
Gotcha.
determining whether you pass or not.
Okay. Okay. So let's say a company passes the benefits test. What happens next? Like, how do they go about pricing these intercompany transactions?
Yeah, so I mean, kind of going back to what Abbas mentioned about arm's length pricing, which is
Yeah.
basically determining an amount that two unrelated parties would, I guess, price a transaction or a service
Okay.
transaction in this
Okay.
case. So that's the first step, and that's the ultimate goal. So there's two different types of, I guess, things that you can do to find an arm's length price.
Okay.
There's transactional methods and there's profit-based methods. So
Okay.
there's transactional methods is something where you're finding comparables, and an instance would be doing like an internal comparable. So say you are a company and you went to Bennett Thrasher
Yeah.
and did accounting services and you asked them to do some kind of tax work or something like that. If you happen to get somebody in-house to do that and do that substantially similar function, then an arm's length price would be pretty much what you just paid Bennett Thrasher to do the same thing.
Okay.
So if you have that kind of level of support, that is the best you can do across the board. If it's services transactions, if you're buying tangible goods or whatever, like that type of support is the best.
Okay.
If you don't have that available, then there's the external comparables where, like, we've done projects where we'll just look at market data and find, like, what this professional typically gets paid in this market.
Gotcha.
And then on a yearly basis, we usually just adjust for like cost of living or inflation.
And I would just add to Kyle's point in that these transactional based methods, they have a higher degree of comparability standards than the profit based methods. So as Kyle was saying, the accounting function in his example should be pretty similar. And so we would look at it from what is the level of the group accountant? Is he a manager? Is he a staff level?
Right. Okay.
And really try to look at the comparability of what maybe Bennett Thrasher is providing. Did Bennett Thrasher provide audit services and this person is doing tax services? We would look to see if there's a differential in the rates. There may not be, there may be, and we just need to properly reflect those facts in the kind of pricing policy for the transaction. Profits-based methods have a little less degree of comparability standards, so they're a little bit easier to implement in the real world, and I'll let Kyle kind of explain that a little bit.
Yeah, I mean, and that's a lot more common as far as what we do is finding profits based especially for services transactions.
Okay.
And that's where we basically will find comparable companies doing substantially similar functions, and then look at their financials, their publicly available financials. And the key is that it's not necessarily what the service provider type of business they're doing, it's more the function. So, like, if we're looking at marketing, maybe it could be like a software company, but the intercompany transaction is a marketing service. We would look at comparable marketing companies.
Marketing service providers, not software companies.
Yeah, and because it's narrowing down to like the simplest, I guess, least complex thing. That
Function.
Function.
We're trying to isolate the actual function and service from the overall kind of business, whether they're in locomotives and airplanes or whether they're in software.
Right.
It's more about what is the actual, what we call covered transaction or covered activity that we're actually trying to evaluate.
So we would look at, again, comparable companies that are, I guess in this case would be marketing companies, and we look at their financials, and then there's different, profitability indicators that we use. I mean, you can look at gross margins, operating margins. We use different ratios like return on assets in some instances. But in like services transactions, probably the most common is just cost plus a markup. Cost plus. So, that's probably the most common.
And a cost plus markup really means that the service provider is going to recoup its costs and then adds essentially some type of profit element. to
Okay.
those costs. And so that's pretty similar to how most service businesses operate. You know, you have your people,
Right.
they cost $100, and
Right.
then you like, okay, I need to charge something so that I get $200
Yeah,
revenue.
yeah,
So
yeah.
you know what I mean? So
Yeah.
that profit margin is what we are measuring with the data
Okay.
that we have available to us. And it depends on the service and
Right.
everything. That profit
All
margin can be
those,
very
yeah,
different.
all those factors.
But that's what we're kind of looking at.
Okay.
Yeah. So once we find like I guess a set of comparable companies, we find a range that's suitable, and that's what's considered arm's length, and then
Okay.
and then that service provider, or that business owner will say, okay, well, between 7 and 10% is a good markup for this service.
That wraps up part 1 of today's episode of Beyond the Ledger. A huge thank you to Abbas, Raza, and Kyle Ergle for breaking down the complexities of transfer pricing and giving us a clear, practical look at how Bennett Thrasher helps companies navigate cross-border transactions with confidence and compliance. Stay tuned for part 2 of our conversation with Abbas and Kyle up next.